Because the IRS consider virtual currencies property, their taxable value is based on capital gains or losses, basically how much value your holdings gained or lost in a given period. Let's get into it. When you trade cryptocurrencies or when you spend cryptocurrency to buy something, those transactions are subject to capital gains taxes because you're spending a capital asset to get something or get another asset. The difference between the amount you spend when you bought or received the crypto is cost basis, and the amount you earn for its sale is the capital gain or capital loss, which you'll report on your tax return. Broadly speaking, if you bought $100 worth of Bitcoin and sold it for $500, you'll see a capital gain of $400. If your Bitcoin lost value in that time, you'll instead face a capital loss. If your loss exceeds your gains, you can deduct up to $3,000 from your taxable income for individual filers. The amount of time you owned the crypto plays a part also. If you held onto a unit of Bitcoin for more than a year, it would generally qualify as a long-term capital gain. But if you bought and sold it within a year, it's a short-term gain. These differences can affect which tax rate is applied. The tax rate also varies based on your overall taxable income, and there are limits to how much you can or may deduct in capital losses if your crypto asset loses value. Short-term capital gains are taxed as ordinary income according to the 2022 federal income tax brackets. You can use Form 8949 to reconcile your capital gains and losses, then report them on your Form 1040 tax return using Schedule D. If you're an NFT investor or hobbyist, you can use the same form to report NFT minting gains or losses in NFT trades. Just make sure to enter code C in a column F to show that you sold an NFT, which is treated as a collectible. The IRS website has additional information and tools to help you determine your crypto-related tax liability and how to report it on its website. Reporting crypto income. Some people receive virtual currency as payment for services. This might mean receiving crypto as income instead of cash, earning Bitcoin by mining new coins, or receiving coins or tokens as reward for certain activities. Coinbase Earn Rewards program, for example. Regardless of how it's earned, you'll need to record the value of the crypto in US dollars when it's received and report that income on your tax return. For example, if I get paid 1 Bitcoin for services, I have to grab the fair market value for that Bitcoin at the moment I received it. Right now, if Bitcoin is at $80,000, I have to record $80,000 of revenue as personal income. The IRS puts it this way. A taxpayer who receives virtual currency as payment for goods or services must, in computing gross income, include the fair market value of the virtual currency measured in US dollars as of the date that the virtual currency was received. That fair market value you capture sticks to that coin at that cost basis, which is your responsibility to track. So if you go and buy something with crypto you've earned, you'll need to reconcile its cost basis with its value when you use it for goods or services. Track your activity. One of the most important things to remember as you start dealing in cryptocurrency is that it's your responsibility to keep track of all your potentially taxable activities, as well as the fair market value for your crypto throughout those activities. The IRS offers only general guidelines about the records you'll need to keep for tax reporting purposes. They should be sufficient to establish the position taken on tax returns. Some examples the agency gives includes records of any time you receive, sell, or exchange virtual currency, as well as the fair market value of those virtual currencies. Crypto reporting and tracking is a big scary thing for many purchasers. Getting into the crypto space can be incredibly simple, but actually tracking the cost basis and making sure you're doing it correctly, that's where it gets really tricky. Some exchanges may issue a Form 1099-B to help you determine gains and losses, but that's uncommon. Ultimately, it's your responsibility for tracking your taxable activities and your currency's fair market value. Looking ahead, that wouldn't be the case for the 2023 tax year. A section of the $1.2 trillion bipartisan infrastructure bill signed into law by President Biden last November requires brokers, aka cryptocurrency exchanges, to issue a 1099-B. In other words, crypto exchanges will be required to notify the IRS directly of crypto transactions. Do not expect cryptocurrency exchanges to give you a tax form this year. The bill for the 1099-B forms applies to the 2023 tax year. For 2021 and 2022 tax years, you're more than likely not going to get a 1099-B. There are crypto-focused tax software programs you can use to simplify the process. As long as you input data on all your crypto trades or earnings across all exchanges you use, the software will generate the cost basis for the trades and help you determine your capital gains and losses. Some of these programs, Coin Tracker, Token Tax, CryptoTrader.tax, and more, are compatible with your regular tax programs like TurboTax or TaxAct, so you can easily import the gains and losses they report to your tax return. How to prepare for tax season when you have crypto. The best thing you can do to simplify your crypto-related 2021 tax filing is to start planning ahead now. Don't wait until April 1st, 2022 to begin gathering your reports and figuring out what you owe, even if that's how you typically approach tax season. Trust me, you do not want to be in that situation in April when you are trying to catch up with 1 year's worth of crypto activity. You really want to treat it more like a business, where on a monthly basis you are making sure that all of your taxes are up to date, making sure you are tracking these things correctly, and being more proactive about it. If you're just dipping your toes into trading Bitcoin or another cryptocurrency and only have a few transactions, with accurate cost basis reporting, you may be able to easily report your crypto earnings yourself using your typical tax software. Most people are pretty simple. They have a W-2, they have a couple 1099 interest forms, and they may have some crypto. So those people don't really need a CPA. But if you're somebody dealing with large amounts of money, you're making DeFi transactions, staking or mining operations, those people will want to have a CPA to sit down and do tax planning and tax saving strategies. Consider working with a professional. Even if you are not conducting complex crypto activities and just have questions about your specific tax obligations, or you're unsure if you're reporting correctly, consider working with a tax professional who has experience interpreting tax code related to virtual currencies. I hope this helped. Take care.